Smart investment strategies. How to start investing with just $100. Investing does not require a hefty sum of money to begin. In fact, with as little as $100, anyone can enter the market and start building a financial future. This session will explore simple approaches that empower beginners to navigate the investment landscape effectively, regardless of their limited initial capital. Simple approaches for beginners to enter the market. Micro-investing apps. Micro-investing platforms like Acorns or Stash allow users to invest small amounts of money regularly. Acorns, for instance, rounds up your everyday purchases to the nearest dollar and invests the spare change into diversified portfolios. This method not only simplifies investing but also encourages regular contributions without requiring significant financial sacrifices. Exchange-traded funds, ETFs. ETFs are an excellent option for novice investors looking to diversify their portfolios without substantial upfront investments. Many brokerages now allow individuals to purchase fractional shares of ETFs, meaning you can invest a portion of your $100 in a fund that holds various stocks or bonds. This diversification helps mitigate risk while providing exposure to different market sectors. Robo-advisors. Robo-advisors like Betterment or Wealthfront offer automated investment management tailored to individual risk tolerance and financial goals. With just $100, investors can set up an account and have their money allocated across a diversified portfolio based on algorithms and investment strategies designed by professionals, eliminating guesswork while keeping fees relatively low. Dividend reinvestment plans, DRIPs. Many companies offer DRIPs that allow investors to purchase shares directly from them without going through a brokerage. These plans often have lower fees, enabling you to start with minimal investment. Additionally, they typically allow dividends to be reinvested automatically, compounding your returns over time. Educational investment courses. While investing $100 might seem minimal, allocating some funds toward personal finance education can pay dividends in the long run. Consider investing in online courses that teach essential concepts such as stock analysis, portfolio management, or fundamental investment strategies, enhancing your ability to make informed decisions about future investments. Community investments. Participate in local community initiatives or crowdfunding platforms focused on real estate or small business ventures. Websites like Fundraise allow individuals to invest in real estate projects with minimal contributions, while supporting local businesses can also be an exciting way to engage with your community and earn potential returns simultaneously. Investment clubs. Joining an investment club enables beginners to learn alongside others interested in investing while pooling resources for group investments. Clubs create a supportive environment where members can share insights, strategies, and research, fostering collaboration while minimizing risks associated with individual decision-making. By employing these straightforward methods, anyone can overcome financial barriers and start investing even with limited capital. The key is being proactive, seeking out opportunities that align with personal interests and risk tolerances, while fostering a habit of consistent contributions over time. Master the 120 rule for investing? Risk management is a crucial aspect of investing that determines long-term success and portfolio stability. One popular guideline among investors is the 120 rule, which provides a framework for determining asset allocation based on age, understanding risk management, and investment allocation. What is the 120 rule? The 120 rule states that an investor should subtract their age from 120 to determine the percentage of their portfolio allocated to stocks versus bonds or more conservative investments. For example, if you are 30 years old, you would allocate 90, 120, 30 of your portfolio to stocks and 10 to bonds. Rationale behind the rule? The premise behind this rule is rooted in risk tolerance and time horizon. Younger investors typically have longer investment horizons before retirement, allowing them to ride out market fluctuations more easily while seeking higher returns through equities. Conversely, as individuals age and approach retirement, it becomes crucial to shift towards more stable investments that protect accumulated wealth from market volatility. Adapting the rule to individual circumstances. While the 120 rule serves as a useful guideline, individual circumstances may warrant deviations from this framework based on factors like risk tolerance, financial goals, income stability, and personal preferences concerning investment strategies. Therefore, tailor allocations accordingly. Portfolio diversification within each asset class, stocks or bonds. Further diversification is essential for reducing risk exposure even further. Spreading investments across various sectors, technology, healthcare, helps protect against downturns affecting specific industries. This approach enhances overall portfolio resilience throughout market cycles. Reassessing allocations over time. Periodic evaluations should accompany any long-term investment strategy based on changing life circumstances, for example, marriage, children, or shifts within economic environments, affecting both global markets and personal finance objectives. These assessments ensure alignment between desired outcomes alongside suitable risk profiles consistently. Mastering the application of the 120 rule enhances one's understanding of risk management principles, while informing appropriate asset allocation decisions tailored specifically towards achieving enduring success within personal portfolios. Investment strategies to outpace inflation in a high-interest environment. Inflation erodes purchasing power over time. Thus, developing strategies aimed at outpacing inflation becomes crucial for maintaining wealth during periods characterized by rising prices, particularly evident in high-interest environments where cost of living adjustments impact daily financial considerations significantly. Proactive measures to safeguard investments against inflation. Invest in real assets. Real estate has long been considered a hedge against inflation due primarily because property values tend to rise alongside increasing costs of living. The appreciation in real estate value typically aligns with inflationary pressures over time. Moreover, rental properties can generate steady income streams while offering tangible assets less directly impacted by inflation-related fluctuations compared with traditional equities alone. Consider Treasury inflation. Protected securities, TIPS. TIPS are government-issued bonds specifically designed to protect against inflation. Their principal value adjusts based on changes in the Consumer Price Index. Although TIPS yield lower returns than traditional bonds during stable economic conditions, their built-in protections against inflation provide peace of mind knowing that returns will adjust accordingly alongside rising prices. Focus on dividend stocks. Dividend paying stocks represent another effective strategy for combating inflation. Companies that consistently increase dividends over time demonstrate financial strength and resilience. This stability can serve as both protection against inflationary impacts while also generating additional cash flow into your portfolio. Invest specifically within dividend aristocrats. Companies with records spanning decades showcasing sustained annual growth rates, all providing reliable income amidst fluctuating economic conditions. Explore commodities investments. Commodities such as gold, silver, oil, often serve as natural hedges against inflationary pressures due primarily because these materials typically maintain value during rising price environments. Allocating portions of your portfolio toward commodities or commodity-focused funds can bolster overall performance when stock markets encounter turbulence stemming from economic concern, fueled by inflation rates rising unexpectedly. Adopt tactical asset allocation strategies. In times of uncertainty marked by inflationary trends evolving quickly, it's essential staying agile rather than sticking strictly within predetermined allocations aligned solely based on traditional metrics. By adjusting exposure towards high-growth sectors such as technology during economic expansions while pivoting back towards defensive industries when faced with downturns enables investors not only preserve capital, but also capitalize opportunistically when conditions shift rapidly. Regularly review your portfolio. Periodically reviewing investment allocations becomes crucial for aligning performance expectations amidst volatile environments. Adapt strategies according to changing economic signals regarding interest rates, inflation, along with observing how various investments respond accordingly. Make necessary adjustments aimed at optimizing asset composition, ensuring each component supports overall objectives related directly towards combating inflationary impacts effectively throughout varying market conditions experienced consistently. In summary, navigating smart investment strategies requires beginners not only understanding accessible methods for entry, but also mastering essential principles guiding successful long-term wealth creation. By implementing actionable tactics such as utilizing micro-investing platforms alongside leveraging frameworks like the 120 rule ensures individuals manage risk adeptly while taking proactive measures designed specifically aimed at countering threats posed by inflation within high-interest environments effectively. Through these methodologies, investors cultivate portfolios equipped strategically towards achieving sustainable growth over time, fostering enhanced financial security today into tomorrow's future.